line with us is Morris Pearl, the chair of the Patriotic Millionaires, formerly a managing director on the BlackRock team that the Federal Reserve, Treasury, and FDIC hired to structure and assess the cost of the Citibank bailout back in 2008. PatrioticMillionaires.org is the website. Morris_Pearl or Patriotic Millionaires are the Twitter handles. Morris, welcome back. It's been a while since we spoke. I was just debating regulation, specifically and broadly bank regulation, with a libertarian associate, friend, whatever, fellow who likes to come on the program and debate with me, and Charles Sauer. But it seems like as much as bank regulation is a crisis, and certainly you've been writing and talking about this, the regulation of money in politics is the real issue here, is it not? Because is that not how we ended up without bank regulation?
I think, sadly, Tom, that is true. It's because the few people who can show up at donor events with lots of money get the ear of the politicians. And, oh, it's so inconvenient that we're trying to provide money for job creators and make an enormous profit for ourselves. And, these regulators are getting in our way. And eventually, that's all they hear, because the people who are depositing their money at the bank are not the ones who show up at major donor events for politicians. They just want to have a checking account that's reliable. But, and the libertarians should get rid of bank regulation the same way we should get rid of regulations on, the safety of the ice cream in grocery stores. Right. Everybody can judge for themselves whether the cows are safe that makes the milk that makes the ice cream. Why do we need a government for that? But, I don't think that's practical, and I also don't think getting rid of bank regulation is practical. Right,
and back in the day, in fact, we used to have ice cream that was contaminated with tuberculosis or heavy metals or whatever. Is spot on. So you participated in the oversight of Citibank back in 2008. What lessons from that 2008 experience do you think we should be applying now to this current experience?
Well, the lesson is that bank managers have every incentive to go right up to the line, because from their point of view, they want to take as much risk as possible, because usually they win out. Most of the time it works, and they make huge amounts of profit for their bank and bonuses for themselves. And the few times it doesn't work out, well, they may have to look for a new job, but that's the FDIC's problem to take all the losses. So it's a huge asymmetrical thing. Tails, I win. Heads, somebody else loses,
Right. So should we, here we've got the Biden administration coming out and saying, we're going to bail out everybody who had more than $250,000 in this bank, while FDIC's rules specify only those people who had, deposits of under $250,000 were protected. I could see an argument for raising that, in this day and age to maybe $500,000 or $1 million, but that almost seems like a completely separate argument. Are we not now, by bending the rules essentially and saying no, we're going to protect everybody, essentially throwing out the rules? Isn't every bankster in America going, oh, really? Oh, I guess I can do a whole lot of damage?
Well, no, they're not protecting the banksters. The actual people that worked in the bank are now unemployed, and the actual investors in the bank get nothing. So the people who owned the bank and the people who ran the bank are not getting anything from the government. The depositors aren't either. What they're protecting is the people who have the money in the bank. The people whose payroll checks are due on the 15th tomorrow morning will have good checks.
No, I completely get that.
The payroll processing company.
But what I'm saying is, a week before this went down, the CEO of the bank pulled a little over $3 million out and stuck it in his pocket. It's probably a tip of the iceberg. He probably will never have to work again for the rest of his life, and that's probably true of many of the people who are directors of this bank. And this is a, quote, small regional bank, right?
Well, A, it's not a small bank. It's the 16th largest in the country.
Right.
And B, the reason the CEO may never have to work for the rest of his life is because he may be in federal prison for the rest of his life.
Well, that would be a good thing.
if this this clearly looks like making improper use of inside information.
Right. So I guess my question is, I completely agree with Joe Biden going around the FDIC rules and saying we're going to make all the depositors whole. I don't think he has a choice. I mean, you'd be looking at a major run on small and medium-sized banks around the country, and in fact,
every small and medium-sized bank.
Yeah, exactly. Doesn't that, though, argue that the FDIC's $250,000 limit has now been breached and is meaningless, and that we need to revisit that legislation?
Oh, yes. Yes, I agree with that.
So,
I think the $250,000 limit was kind of ridiculous to begin with, because the people with money in checking accounts are typically people with payroll processors like ADP. When you get your direct deposit every month,
right?
Your employer sends a huge amount of money to ADP, and they send it to your direct deposits, and you probably don't even know what bank ADP uses. So having you responsible for that is kind of absurd. So that's the kind of thing that needs to be protected.
How do we balance this risk? On the one hand, saying to the banks, we're not going to protect you under all circumstances. We're not even going to protect your depositors. We want everybody to have some wariness in the marketplace here. And I know wealthy individuals who have money in multiple banks. And I'm not talking wealthy at your level or the Patriotic Millionaires level. I'm talking people who have a couple $100,000, $400,000 or $500,000 in their retirement fund in their 60s, and they've got it in a couple of banks to not exceed that $250,000 FDIC limit. How do we balance this? The need for safety with the need to have enough risk that there is some caution.
Hey, the guy with the couple $100,000 for his retirement probably has it in mutual funds or government bonds or something, not in an actual checking account.
Right.
That's probably not what he's doing. And two, we need to protect people with checking accounts, and that's why we need regulations on banks. Banks that have money from checking accounts have to be regulated so that money is invested in only low-risk things, and they have to manage their assets and liabilities. These are lessons that we should have learned in the 1980s. Many of us did learn in the 1980s, right, that you can't have deposits that can be withdrawn in 1 day's notice and invest in 30-year mortgages. That's ridiculous, and that's what this bank was doing.
So the stress test would if this bank, basically by when Donald Trump signed that legislation in 2018 to exempt Silicon Valley Bank and another 20 or so banks from the Dodd-Frank regulations, my understanding is the main thing that it exempted them from was the whole stress test process, which would have revealed the stupidity of investing the majority of your assets in long-term Treasury bonds, which is what this bank did.
It wasn't even long-term. It wasn't even long-term Treasury bonds. They call them Treasury bonds, but they were actually mortgages. If you look at their statements, which the CEO signed in February, so he clearly knew about this before February,
right? And
that's when he filed his 12B1 plan to sell the stock, by the way. So it seems clear that he knew about this. If you look on their statement they filed in February with their end-of-year 10K, it clearly tells you that they've invested most of this money, tens of billions of dollars, in mortgage-backed securities. And they're guaranteed by Freddie and Fannie. You don't have to worry about them making the payments. But when rates went up, people make their payments more slowly. They don't tend to refinance. They don't tend to move. And the price of these mortgages just went down precipitously. And that's exactly the bank manager's job, is to think about those things ahead of time, like a year in advance, and know that might happen and not do that because of that risk.
Right. So basically reversing Trump's deregulation of the banks would have, in all probability, prevented this. Do we also need to reinstate Glass-Steagall and separate investment banks from commercial banks?
Well, I think that'd be a good idea, but I don't think that had much to do with this case.
Right.
These guys' problem was not investment banking. These guys' problem were that they were investing deposits in 30-year mortgages,
right,
which, anyone who's taken asset liability management 101 should know that's not what you do if you're running a bank, or that's not what you should be allowed to do anyway. They were just making a huge risk, thinking they might make a lot of money, and the FDIC will take the risk if they lose. So who cares?
Yeah, which raises the question. I understand that one of the larger depositors in this bank pulled all of his money out, or most of his money out, and suggested to his colleagues, who were also large investors, that they should pull their money out, and apparently did not believe that that would cause a crisis for the bank. There's kind of
or maybe knew it would cause a crisis and didn't care.
Or maybe was shorting the bank. I mean, God only knows. But is there oversight on that sort of thing? I mean, should we be protected from large depositors?
Well, I mean, people can deposit a lot of money in the bank. Maybe they shouldn't, but some people do have legitimate reasons for keeping large amounts of money in the bank.
Right.
And the whole idea of a bank account is you can take it out whenever you want. If it's not, then it's not really a bank account.
Right.
So I don't think we can say that people aren't allowed to make large amounts of deposits and withdrawals. I think we have to say that bank management has to be prudent enough to invest their money in such a way that they're okay if that does happen.
Right.
The bank manager should have known that's one thing that might happen, is these depositors withdrawing their money.
Yeah, I totally get it.
They're supposed to think about all these different possible scenarios.
There you go. Morris Pearl, chair of the Patriotic Millionaires, who I mentioned in my op-ed today over at HartmannReport.com, by the way. Patriotic Millionaires. Morris, thanks so much for dropping by. It's great talking with you again. Thank you.
Great to be in your show, Tom. Thank you. Yeah, bye-bye.